Hello and welcome to the FT headquarters for the latest in our Global Asset Tracker series of interviews with investment experts and portfolio management experts of private banks. Today we'll talk about asset allocation with a focus on risk assets and equities in particular. To discuss these topics, I have with me Gavin Rankin, Head of Managed Investments at Citi Private Bank for Europe, Middle East and Africa. Welcome, Gavin.
Thank you very much. Nice to be here.
Gavin, stock markets had a very dreadful start to the year. They've regained most of their losses, or all of their losses, since their trough in mid-February. And they seem to have digested the failure of the Doha meeting about the oil production freeze. So it seems that investors are perhaps more focused on positive flow from US economic data, stability coming from China, perhaps the benefits for non-energy related stocks of lower oil prices. What do you think? Do you think it's a temporary pause in markets? What are Citi's views on equities, and how are these views implemented in clients' portfolios?
Well, thank you. It's a very pertinent and very relevant question. As a house, Citi is constructive on risk assets. We've been constructive going back a significant period of time. Where we find ourselves now is in reducing our risk overweight. We've reduced from a peak of about 6% overweight in equities to slightly over 1% today. We think the periods such as we saw during the first quarter are really going to be characteristic of the stock market between now and the next 18 months. They are reflective of investors trying to come to terms with the late stage in the US economic recovery. And therefore, volatility, particularly in risk assets, is what we would expect to be the characteristic of markets.
Mm-hmm. And we carried out a survey on 35 private banks in January, and the majority of private banks had an overweight to European equities, so preference for European stocks rather than US stocks. They believe that European stocks are going to deliver better earnings growth, higher dividend yield, and they'll benefit from the monetary policy of the ECB, whereas the Fed is stepping back. They are cheaper. So do you agree with all these arguments about European stocks? And there is an increasing perhaps worry among investors about the ineffectiveness of the monetary policy.
Well, we have overweights in both US and European equities, but European equities would be our larger overweight. I mean, we're still constructive on the United States. We still think there is sluggish but still positive growth for the next year or so. And that's reflected in terms of our overweight. We think corporate earnings, there aren't going to be any significant negative surprises during the current earnings season. So we think that valuations, though stretched, they're still supportive of equity valuations in the United States, equity prices in the United States. In Europe, the story is slightly different. Europe is earlier in terms of the recovery, and therefore we're still very much in that upswing in terms of valuations, increasing in terms of European risk assets. As you said, monetary policy is broadly supportive in Europe. The central bank is obviously buying bonds, which is supportive. Interest rates are at record low levels. When you look at some of the external factors, relative euro weakness and oil prices coming down, all of those factors come together to be very supportive of European equities. And therefore, European equities are our largest overweight in terms of our equity allocation.
Mm-hmm. Do you have any preferred stocks? What are the great unloved stocks of today, would you say, in Europe?
I think if you look across all global equity markets, but if we look particularly at Europe, selectivity is incredibly important. It's important on a country basis, it's important on a sector basis, and important on an individual company basis. I think there are a lot of macro decisions that are being made that will be quite supportive of particular sectors. If you look at financials, for example, financials had a very difficult first quarter in Europe. But if you look at some of the news coming out of, say, Italy in terms of resolution of, or not resolution, but at least action being taken on the non-performing loan side, action like that can be quite positive. So for investors, we look to areas that are unloved, as you say, where there is some potential catalyst in terms of policy that could lead to an upswing in terms of performance. Elsewhere, we're very positive on sectors such as healthcare and technology, where you're seeing fantastic innovation coming through, leading to some very strong returns for investors.
We've had some encouraging signs of recovery from emerging markets, and emerging market stocks have outperformed their developed market counterparts in the first quarter of the year, and investors who had shied away from this asset class seem to have returned to emerging markets. Do you think it's a good time today to start investing, going back to emerging markets?
Emerging market risk assets have been a roller coaster for investors. It takes a brave investor to significantly increase their exposure to that space. At the beginning of the year, one of our big themes was emerging markets, but it was more of a longer-term theme. We expected valuations to become quite cheap in terms of markets, but then we expected that to be followed by a relatively strong risk rally. We think that's where we are today. Further out, we wouldn't recommend that investors significantly increase their exposure to emerging market assets until we've passed through a period of US economic slowdown, which we think is probably the second part of next year. So where we are today is a trading rally. If you look at some of the strong performers, such as some of the Latin American stocks, it's coming off a very significant low. With emerging markets, we think that some of the risk aversion is going to move from Latin America to Asia, based primarily on valuation. There's a space we would be reticent to significantly increase risk.
Looking at the passive versus active management space, from an S&P analysis of the performance of after fees of 25,000 funds in Europe, appeared that 86% of active funds have underperformed their benchmark over the past 10 years. Do you think this is going to drive increased inflows into ETFs, and do you increasingly use ETFs in client portfolios today?
Both ETFs, both passive investments and active investments, have a role within a portfolio. Different market environments are supportive of each of them. If we look at the first quarter of this year, active managers have particularly underperformed. Stock correlations significantly increasing, significant movements in market volatility, inevitably they're going to impact active managers. And therefore we've seen an increase in interest in passive investments. But both instruments, I think, have an important role within a portfolio. But what I would say about active management particularly is it's not throwing a series of darts at a dartboard and hoping that you get the right manager. There is a significant amount of work that you need to do in terms of investment due diligence. The sustainability of investment returns over the long term is something that very few managers can achieve. And therefore, as a house, we would recommend both passive investments in a portfolio, but also active investments underpinned by a significant investment due diligence analysis.
Finally, what is the investment vehicle that is most underrated, perhaps in diversifying portfolios today?
I think the best way to manage volatility across your portfolio is diversification. And I think if you look at the environment that we see today and what we would expect over the next 18 months or so, we think that hedge fund strategies, and particularly those that are quite focused on volatility, play a very important role in client portfolios. And therefore, one of the strong messages we're taking to investors today is to look at some of these CTA strategies and the macro strategies, and those strategies that offer a degree of diversification to broad equity and fixed income markets. They act in many ways as an option hedge. There's convexity in terms of their investment returns, and therefore using them as a degree of portfolio insurance, but also as an uncorrelated source of returns, we think is a very attractive way to play these markets.
Thank you very much, Gavin.
Thank you.